Welcome back to Store University, Lesson 3, the V Formula. I'm Chris Volk, CEO of Store Capital. In the previous video, I discussed the first 3 V Formula variables. Those variables were sales, investment, and annual capital investment. So now I'm going to review the final 3 variables, and we'll put the formula together in an example. Step 4 of the process is operating profit margin. A higher operating profit margin, which is earnings before interest, taxes, depreciation, and amortization as a percentage of sales, has a very positive impact on pre-tax current returns on equity. Operating profit margins also tend to be higher at higher sales levels. And this is because businesses tend to generate the highest profits on the last marginal dollar of sales. Companies with higher sales volumes also tend to have lower operating costs as a percentage of sales. So the 5th variable is the debt-equity mix. Debt is less expensive than equity, which means that a higher portion of debt will raise returns on equity. However, higher debt levels raise investor and lender risk profiles, which can raise the return requirements of both. While there is definitely a chicken and egg issue here, this financial balancing act generally begins with shareholder return expectations. It is important to note that borrowing terms will also impact current pre-tax returns on equity by changing the debt-equity mix as loans pay down. So, all other V formula variables equal, debt reduction over time is going to reduce returns because borrowings are being replaced by equity. So the last variable is the cost of those borrowings. The cost of borrowings is the final V formula variable and should be the last variable considered. The other 5 variables are each individually much more important. And this is because lower cost borrowings can result in restrictions to other V formula variables, which creates an opportunity cost. This will be discussed in a future Store University lesson. Now we have a chance to put the V formula together, and it looks like this. You start with sales, you divide sales by the investment, multiply that by the operating profit margin, subtract the proportion financed times the interest rate, less the capital expenditures made every year divided by the investment. And you take all of that and divide that by the proportion of equity. And if you do that, you'll get the current pre-tax return on equity. So let's plug in the variables using the example at the very beginning of this lesson. You take $1.5 million in sales, divide it by the $1 million of investment. You multiply that by the 20% EBITDA margin. Subtract the product of 75%, which is the proportion of the company funded by leverage, times the cost of that leverage, which is 9%. And then you subtract your annual recurring capital expenditures as a percentage of the $1 million investment. Now, divide this by the portion of the business that's funded with equity. That amount is going to be the inverse of the portion funded with debt. And there you have it, an 85% current pre-tax shareholder rate of return. And if you want to know how many more times your equity investment is worth than you paid for it, well, you just divide the 85% by the marketplace expected rate of return of 20%, and your equity is worth 4.25 times more than it cost. How about that? So until the next lesson, I'm Chris Volk, and thanks again for joining me on this value creation journey.